Asterisk what I'm about to explain may determine whether your money steadily grows over time or quietly loses its power year after year. It doesn't matter if you've been investing for decades or you're just beginning to think seriously about your finances. This message applies to everyone paying attention to today's economic reality. We are entering a financial environment that does not reward hesitation. In fact, it steadily erodes the purchasing power of people who believe holding cash is the safest move. Many think they are being cautious, but in reality, they are exposing themselves to a slow and predictable decline in real wealth. Asterisk, before I go deeper, I want you to pause for a moment. If your goal is to protect your money, build long-term stability, and understand how capital actually works in modern markets, then subscribing to this channel matters. The purpose of this content is not entertainment, it's clarity. It's about helping you think differently about money, risk, and opportunity. If that matters to you, subscribe now, and while you're here, consider how much of your portfolio is currently sitting in cash. That detail alone reveals more than most people realize. Asterisk, here's the core reality many avoid discussing clearly. Cash loses value over time in an inflationary environment. Even when savings accounts offer modest yields, they rarely keep pace with rising costs across the economy. While your account balance may appear stable, the real-world purchasing power of that money gradually declines. Prices for essentials like food, housing, transportation, and healthcare continue to rise faster than most cash yields. The result is a slow erosion that often goes unnoticed until years have passed. Asterisk, to make this practical, consider a simple example. If inflation averages 5 to 6% annually and your cash earns less than that, the difference represents a real loss. Over time, that loss compounds. The number on your bank statement may stay the same, but what that number can actually buy becomes meaningfully less. This isn't speculation, it's arithmetic, and it affects anyone who holds excessive cash without a clear strategy. Asterisk, many people describe this approach as being careful. They say they are waiting for the right moment or trying to avoid risk. But there is an important distinction between thoughtful liquidity and prolonged inactivity. Liquidity is necessary. Every household should maintain an emergency buffer, but holding large amounts of idle cash beyond that serves a different function. It creates exposure to inflation risk without offering meaningful upside. Asterisk, strategic liquidity typically means keeping enough to cover several months of expenses and maintain flexibility. Asterisk, beyond that threshold, each additional dollar sitting idle is a dollar that is not contributing to growth or income. Wealthy individuals and institutions understand this distinction well. They do not accumulate cash as an end goal. They accumulate assets that generate income, appreciate over time, or provide inflation protection. Cash is the tool used to acquire those assets, not the destination itself. Asterisk. This distinction becomes even more important when you consider the broader monetary environment. Over the past several years, global money supply has expanded dramatically. When the supply of currency increases faster than the production of goods and services, the value of each unit declines. This process is gradual but persistent. It is not driven by individual choices, and it is not something any one person can control. The only practical response is to position your capital in ways that historically retain or increase real value. Asterisk, ask yourself this. If an option guaranteed a slow loss of purchasing power, would you intentionally choose it? Most people wouldn't. Yet that is effectively what happens when excess cash is held indefinitely during inflationary periods. The challenge is that this loss is subtle. It doesn't feel dramatic. It doesn't trigger headlines every day. But over long periods it materially affects outcomes. Asterisk, so what does a more effective approach look like? It starts with assets that produce cash flow and have a history of adjusting to economic conditions. Dividend-paying stocks are one example. These represent ownership in operating businesses that generate revenue and distribute a portion of profits to shareholders. When selected carefully, such companies often operate in essential sectors and maintain pricing power over time. This creates income that can help offset inflation while also allowing for long-term appreciation. Asterisk, reliable dividend-paying businesses tend to share certain characteristics. They operate in sectors like utilities, consumer staples, healthcare, and financial services. They have long operating histories, consistent earnings, and established dividend policies. Over extended periods, dividends combined with price appreciation have contributed significantly to total returns. This dual effect stands in contrast to idle cash, which provides neither growth nor inflation protection. Asterisk, another component worth understanding is fixed income. Bonds are often misunderstood, but in environments where interest rates are higher, they can offer attractive yields. High-quality bonds provide predictable income and defined maturity dates. When structured thoughtfully, they can play a stabilizing role in a broader portfolio. Using staggered maturities allows investors to reinvest at prevailing rates over time, reducing sensitivity to rate changes. Asterisk, real estate also remains a critical pillar for many portfolios. Whether through direct ownership or real estate investment trusts, income-producing property has historically served as both an income source and an inflation hedge. Rental income tends to adjust upward over time, and property values often reflect long-term economic growth. REITs in particular, offer access to diversified property portfolios while distributing a large portion of income to investors. Asterisk, the unifying principle across these asset classes is diversification. No single investment performs optimally in every environment. A balanced allocation across income-producing assets can reduce volatility while maintaining growth potential. This approach does not eliminate risk, but it replaces passive exposure to inflation with active participation in productive economic activity. Asterisk, it's also important to recognize that waiting for perfect conditions is rarely productive. Markets fluctuate. Economic uncertainty is constant. Those who build wealth over time typically do so by remaining invested, rebalancing as needed, and allowing compounding to work. Attempting to time markets precisely often leads to missed opportunities and prolonged inaction. Asterisk, consider how often anticipated downturns fail to materialize as expected, or how recoveries begin before consensus shifts. Capital that remains on the sidelines during these periods does not benefit from growth. Over long horizons, participation matters more than precision. Asterisk, the practical takeaway is not recklessness, but intentional action. Review your current allocation. Identify how much cash you are holding beyond necessary reserves. Develop a plan to gradually deploy excess capital into diversified assets aligned with your goals and risk tolerance. This process does not require perfection. It requires consistency. Asterisk, fear and uncertainty are natural responses to complex environments, but they should not dictate long-term strategy. Risk cannot be eliminated entirely, but it can be managed. Inflation risk, however, is often overlooked precisely because it feels passive. Addressing it requires moving beyond comfort and toward structure. Asterisk, the difference between those who preserve purchasing power and those who lose it over time often comes down to this understanding. Cash feels stable, but stability without growth in an inflationary system is an illusion. Assets introduce variability, but they also introduce opportunity. Asterisk, if this perspective challenges how you've thought about money, that's the point. Reframing assumptions is how better decisions are made. Small changes in allocation today can produce meaningful differences years from now. The tools are accessible. The information is available. The remaining step is execution. Asterisk, take a measured step. Review your position. Decide how much liquidity you truly need. Begin transitioning excess capital into assets that work alongside economic reality instead of against it. Over time, this approach builds resilience, income, and long-term flexibility. Asterisk, that is how purchasing power is preserved. That is how capital remains productive. And that is how long-term financial outcomes improve, not